put in the Q&A window the name of the country where you're located. So this way we know you hear us, but plus I'm always curious to know what countries we have the participants from. So I see Jemina from Saudi Arabia, Sharif from India, Louise from the Netherlands, very nice. So then we have Croatia, Petra from Croatia, Andrew from the United States, very nice. So it seems like the system is working. So we have quite a few countries. Very good. So it seems like the system is working. So let's start with our webinar. Annette is the host today and she will be running the meeting. I will just say a few words of welcome. First of all, Mr. Wachira, thank you so much for finding the time to meet with our students. I know you're a busy man and truly appreciate that you found some time to share your wisdom and experience and skills with us. Annette told me that you still have limited information about Xculture, so maybe very briefly I will tell you about our project here. Oh, you have your assistant there. So, Xculture has been around for about 11 years, and we do several things. Our main sort of product, so to speak, or program is one where we place students in international teams so that each team is comprised of about 6 people, each in a different country. And so every semester we have over 6,000 participants. This semester we have over 6. Last semester it was a little bit fewer. It still keeps growing. They come from this semester by the location of the student from 83 countries, if I remember correctly, 180 something universities. As I said, pretty much all continents, all major island groups represented. And so the students work on a project together, and as they are interacting with people from different countries, cultures, time zones, they kind of learn the challenges and best practices of global collaboration. And then in addition, we do a few other things. One, lately, we also allowed non-student participants in the program. So it used to be all MBA students and business school students. Now we do have some pre-college teenagers and non-student adult professionals. Second, some participants, like our coaches here, Annette, Ania, after completing the project as a team member, they volunteer to be mentors or coaches for the new generation of Xculture students. We have quite a few students who express that interest, but obviously not everyone is accepted. So what we do is we ask the applicants to the coaching program to go through an additional training program. So they have to complete 16 training modules, do 4 tests. And so those of them who succeeded those tests then become essentially big brothers and sisters, so to speak, to the new generation of Xculture students, and now gain experience in management, mentorship, coaching, so things like that. And then also before COVID, we would have 2 Xculture symposia a year where we bring our best students for a face-to-face meeting. And usually we call it the Business Week Symposium, so it's a whole week. And so the last one was in Canada before the whole thing broke down, before that in Italy, before that in the United States, and so on and so forth. And so that's an opportunity for the members of the best teams to meet their teams, to see a new country, to visit some companies, sightseeing, things like that, career advice, webinar, seminar, all that kind of stuff. So yeah, and here we are. So, but let's talk more about your topic today, the financial education. So I see that we have here on the list such subtopics as capital markets, finance and investment, importance of saving, and related topics. So I guess I will turn the microphone to Annette and our speaker here and let them manage the meeting. And I'll stay, as I said, I'm very curious to learn from the speaker too. Thank you.
Okay. Thank you, Dr. Vas. I can see you kind of tried to preempt his presentation, but I will just give a little bit of information about Alex. For those who do not know me, or for the people who are joining the meeting today, my name is Annette. I am a senior coach with Xculture. I am from Nairobi, Kenya. Our guest speaker today is Alex. I am proud to say he is my brother, for those who didn't know. And he is the he is the head of fixed income trading and at FIDA Investment Bank. He is a certified automated trading system trader. He is a Chartered Institute of Securities and Investments certified, that is CISI2 certified. He's a member of Board Market Association of Kenya. He's our board member, Bond Market Steering Committee of Kenya Association of Stockbrokers. He has broad experience in advising institutional and corporate investors, corporate finance consulting, and research analysis. I will take this opportunity to invite him to speak to us. He has a lot to teach us, and I beg you not to turn your attention off this. Welcome, Alex.
Thank you, Annette, for such a wonderful welcome. And Dr. Jas, thank you very much for coming up with such a program. 11 years, that means that you have been doing this consistently, and that is the reason why you are able to reach 83 countries, and you are able to get in touch with at least students from 180 universities worldwide, which is not a mean feat. That is a great achievement. I am proud to join you this. Here in Kenya, it is in the afternoon. It is 4 p.m. in Nairobi. So I'll say it is a pleasure to join you this afternoon. I know in the US, it is in the morning hours, which is okay. So I'll also tell you good morning. Let me delve straight to the agenda of the day. I'll briefly do an introduction of myself and as well as FIDA Investment Bank. I'll also do a brief introduction of what is finance. Finance is a very broad topic. It has a lot to cover, but I'll try to be brief and precise and give you what is really required. How do you handle your goals? And in this aspect, we are talking of your financial goals. I'll also tackle the categories of finance. Then I'll briefly take you through the journey of investing. Then I'll give you a brief overview of assets, and mainly assets of investments, especially in fixed income trading, and basically managing your finances. Then I'll tackle the future of finance as a last topic. Then I'll briefly allow a few questions and answers. So moving straight to who we are, I work for FIDA Investment Bank. FIDA is a Kenyan investment bank. We are stockbrokers. We trade in shares listed in the Nairobi Securities Exchange. We are licensed by Capital Markets Authority, and we are members of Nairobi Securities Exchange. We also have a firm in Rwanda, that is Rwanda, FIDA Securities Rwanda, where we also trade in the listed shares in Rwanda Stock Exchange, as well as Treasury Bonds and corporate bonds in Rwanda. We have a range of products that we offer. We do capital raising for corporations. We do equities trading, that is shares and trading of shares. We also trade bonds. We also help companies deal with the mergers and acquisitions. Recently, we were behind Seaboard. We were the lead transaction advisors when Seaboard was acquiring a Kenyan milling company called Unga Limited. We also have access to alternative investment markets in the global market. And then we also do investment management to a diverse base of investors with economic interest in Kenya and in East Africa. We also offer...
I'm sorry, Alex. Do you mind if I request for you to share your screen if you don't mind? So that in as much as you're talking, people can just be able to browse through. And for the audience, I would like to request you to, if you have a question, you can type it on the Q&A section so that we can be able to collect them, and we will answer them at the end of the session. Thank you.
Okay. Let me know whether you can be able to see my screen now.
Yes, we can.
You can, eh? Good. So let me take you through from the beginning where we started. Briefly, the agendas, you can see the agendas of the day: introduction, what is finance, how to handle your financial goals, categories of finance, investing and your journey of investing, overview of the main asset classes, then the fixed income securities and the future of finance. As you can see, as I had stated earlier, FAIDA, we are Kenyan Investment Bank. We are stockbrokers licensed by Capital Markets Authority. We trade in Nairobi Securities Exchange as well as Rwanda in the FAIDA, in the Rwanda Securities Exchange. Our main role, capital raising. Capital raising is where you have a company. You have, I'm sure, Dr. Taras, Ania. I'm sure very soon you'll start your own companies, or Dr. Taras has already started your own company, where you may need to raise capital for the company. Then you can come to FAIDA or your local stockbroker, and they can be able to raise capital for you. Briefly, that is my profile. I'm the head of fixed income in trading in the FAIDA Investment Bank. I'm a certified automated trader. Have a certificate in the Chartered Institute of Securities, CC. Member of Board Market Association, and a board member with the CASIB, as well as broad experience in advising institutional and corporate investors, corporate finance, consulting, and research analysis. So let us now get to what is finance. Ladies and gentlemen, finance is defined as management, creation, and study of money and investments. Every day, whatever you do, there is an income that you're managing. What you decide to go and shop, that is about finance. The income that you make, how you spend it, that is finance. So finance deals with three main categories, and that is individuals, your own personal income, your salary, your savings if you're a student, when you aspire, when you get employed, what you'll be earning, that is now personal finance. Companies as well have an issue of finance, and government. So finance is therefore defined in three broad categories: personal finance, corporate finance, and public finance. Then we get to, I want to briefly tackle personal finance. And personal finance is about self. What do I mean by self? It's about the individual. It's about Annette, it's about Alex, it's about Dr. Taras, it's about Ania, it's about you and me, your income. When you deal with personal finance, you have goals and aspirations where you are talking of, you want to buy a home at a certain point, you want to have your own home, you want to have your own education insurance, your health insurance. You also want to plan on the future. When you want to plan on your future, you want to plan on your retirement, because you'll not stay forever young. So these are the categories that deal with the personal finance. You want to have, for example, when you're employed, you talk to your employer and tell them, now I've realized that I'm poor in managing my personal finances. I want to come up with a check-off plan whereby if I'm earning $100 per day, therefore it means that in a month I'm earning $3,000. I want a check-off plan where after the taxes, if once your accountant pays the taxes that are payable to your government, you remain with $2,500. You want to tell yourself that I can manage to save $500 in a month. So you come up with a check-off plan whereby you tell your accountant, this amount of money, please pay this insurance company. What are the benefits? You do not get to touch that money. That money goes straight away to your insurance company, where now you start your own saving plan, deliberate saving plan, And that gives you a lot of discipline, because most of us have an issue of managing personal finances. You'll say this month, you keep on postponing that. Let me not save this month, I'll start next month, I'll start the next following month, year in, year out. So such programs as check-off plans, insurance, buying education policies for your children, buying insurance policies for your own self and for your siblings, that is a part of the personal finance. And how you start your journey towards saving, you have to make deliberate efforts in managing your own personal finance. Let me briefly touch on corporate finance. Corporate finance is very broad, and companies like Faida, that is what we do mainly, because we deal with a lot of mergers and acquisitions. We deal with the companies that want to borrow from the public. They can issue something we call a corporate bond. I'll touch on bonds slightly later. They can do something they can issue something we call a commercial paper. At the same time, companies can talk to banks, and they get what we call short-term capital injection. Short-term capital injection can be where a company will say that we'll give this facility to the bank, and the bank will in turn give us X amount of money, say $10,000, $100,000, for us to expand. For example, it could be you could be running a fruit processing company, where you want to buy a new plant, or you want to, if you're doing juice processing and you're doing orange, and now you want to pursue further and do passion juice, so you will need to buy another plant. The only way now a company can raise that kind of capital is through what we call short-term capital injection. So the company talks to its mother bank, the bank takes something that the company owns as a collateral, then the company will give, the bank will give the company the $100,000 to buy the new plant, and within a short span of time, it can be able to repay. So that is short-term capital injection. It's part of corporate finance. Corporate finance is about balancing the risk and profitability of the company. So most of you who are students, I will tell you, the field of finance is very broad. We have so much that is unexplored. So this is somewhere that I will tell you that you cannot go wrong once you go to corporate finance. The other way of raising capital, you have heard once in a while that a company is listing at the exchange. Listing is where the company issues shares, and shares are bought by the public. When the shares are bought by the public, it means the company will receive an amount of money that it can use for its own expansion. The good thing of listing is that this money that the company has taken from the public is not earning any interest. It is capital that has been injected, but it's capital that does not have a cost. The only cost that the company will incur is when now it is sharing out the dividend. It will pay dividend to more directors and more shareholders, as opposed to when it was a sole proprietor company. So listings are one of the good things that can happen, and that is one of the easiest ways for companies to raise capital, and it's part of corporate finance. However, listing is not that easy. The local capital market has to look at your books and see how profitable the company is, and whether whatever the company is planning to do, the money the shareholders will put in is safe. So that is where we talk of now something we call corporate governance. Corporate governance, that's another story for another day. I'm sure Annette and Dr. Taras will organize for another day where we can talk maybe about corporate governance, ethics, and what have you. The other way of companies raising capital is what we call mergers and acquisition. The most recent big merger and acquisition was when Google was buying WhatsApp, for example, or here in Kenya, we have had Shell being bought, Shell BP being bought, buying out companies like Engine, those are petroleum companies. So mergers and acquisitions are part of corporate finance. The other broad category of finance is what we call public finance. Public finance is now about each and every one of us, but money being managed, resources being managed by the government, either government, municipalities, states, and in this area, government will, through your taxes, it will take your taxes, borrow money from IMF and manage that money through projects. Now that is the aspect of public finance. So briefly, those are three main categories of finance, and these categories, they are broad. We cannot tackle them in a day, but the essence of today's topic was just to ensure that you have an idea of what we call finance. Let me move very fast to where you begin when it comes to investing. Everyone, I believe, Dr. Taras, Annette, everyone else, I believe in this world, you run your own race, and you should never try to run somebody else's race. So each and every day, you have an opportunity to begin investing. You do not need to postpone investing. You just need to decide that from today, henceforth, whatever amount of money I'm making, I'll invest money for the future. How do you do that? You need to have an asset. You need to grow a portfolio. The portfolio that you need to grow when you want to start saving, you need to have three things in mind. The portfolio that you want to grow must be able to meet your basic needs. Basic needs, we will talk about Maslow's hierarchy of needs. Basic need will include your home, your food, your shelter, your clothing. Those are basically your basic needs. You put there education and what have you. Then your portfolio should be able to take care of your basic needs. It should also be able to take care and maintain your standard of living. Each and every one of us has a different standard of living. Where I want to do a holiday, my holiday destination may not be necessarily your holiday destination. So my holiday destination may require me to save $100. Your holiday destination will require you to save $150. Someone else, maybe Dr. Taras, will require to save $200 for him to get his holiday destination. So each and every one of us has a different standard of living. Where I do my shopping, if I do my shopping in a shopping mall, Annette may do her shopping in a different mall. She may need to wear the biggest labels that we have in the market. That is our standard of living. You also have your standard of living where you'll say that your shoe, you cannot wear a shoe that is not Nike, that is not Adidas, that is not Aldo. That is your standard of living. So your portfolio must be able to maintain your standard of living over a period of time. Your portfolio, again, must be able to create an opportunity for you to generate substantial wealth. So those are the three main aspects that your portfolio that you want to start saving must be able to achieve. How then do you achieve that? We need to look at what we call now the Maslow's hierarchy of needs. As I had stated earlier, you have your basic needs. You have safety needs and you have your physiological needs. Your physiological needs are what we call food, water, warmth, rest. Those are physiological. They are part of your basic needs. Safety needs are security and safety because you want to live in a secure neighborhood. So when you're planning your investment journey, you plan with your investment journey with this security basket in mind. So that whatever you will plan to invest in must be able to take care of. You must have, first of all, taken care of these basic needs. Then you move to the important basket. It is not a must-have, but it is important. It has the esteem needs, prestige, and the feeling of accomplishment. You want to also have the love and belonging. Those are important needs. Then you move down to what we call self-actualization. This is where you want to achieve your full potential. For example, right now in the US, you're having your elections in about 2 weeks' time. And you will realize that the two main candidates, wherever they are now in their life, they are looking at their self-actualization. They have achieved whatever requires to be achieved. The only thing now they are waiting to achieve is probably be the president of for Biden, who will be the president of America, for Trump to win the presidency for a second time. Now they are on the self-actualization. For yourself, it will be after you have done your education. For example, you have built your home, you have secured a job. Now you want to build an industry. You want to build a brand. You want to have a global or a regional market. Those are your self-fulfillment. Those are the actualization needs. So whatever now you need to plan in your journey, you must first of all have now the Maslow's hierarchy of need at the back of your mind. Briefly, let me look at your security needs. Your security basket. We have at any one particular point in our life, we run through various risks. You risk losing employment, and that is why you need to have a saving plan. Probably get your health insurance. You risk having an accident that could actually immobilize you. Risk of loss of life. Your investment goal should be to take care of this risk in the event they happen. So you need to invest in a way that, you know, in case I am immobilized for one reason or the other, will my life continue? Will I be able to achieve my standards of living even when I lose my job for the next 4 or 5 months? Will I maintain my standard of living? Will the landlord or the landlady of my house come after me 2 months after my loss of a job because I had not done enough savings? So your investment basket should be able to take care of your security need. At this point, when you're looking at your security need, whatever amount of money you're investing in, you do not look at the return. What do we call return? Return is when you give money to a bank, you need to earn an interest rate on the amount of deposit that you have given. So at this point, because you are taking care of your security needs, the amount of money that you are saving, you may not necessarily need to look at the return it is giving you, because this is an investment that you are making to ensure that your life is secure. We move briefly to the next point where you look at the important basket. That is the second level. This goal is supposed to, the goal is for those who are important to you, your children, your spouse, your extended family. The idea is to maintain your standard of living. The things that are important to you for your happiness and well-being. The investment at this point go into your life to enhancing the basket are those that give you returns that are higher than the inflation. Inflation in the finance world, we look at it on two aspects. There is what we call food-related inflation, where today the price of bread is, for example, costing $1. Tomorrow, that loaf of bread may cost $1.20. The 20 cents is the cost of inflation. So whatever amount of money you are putting in should be able to take care of inflation. So the investments that you make in this sector, you ensure that inflation, the money will take care of inflation such that your standards of living will not be lowered because inflation has come in. The self-actualization basket, these are dreams and aspirations. You want to further your education, but your parents have told you that they will only pay for you up to your undergraduate level. Your postgraduate level, you will know what to do with it. You have to finance it. At this point, probably after getting your first job, you want to start a business, you want to expand your business, you want to have enough money that you can also give to charity, you want to have, you want to travel out of your country, probably to exotic destinations. You want to do, for example, us in Kenya, we like traveling to the European countries. We want to tour Europe. We want to tour South America. We want to tour Australia. You in the US, you want to tour Australia. You want to tour Africa. These are needs that are not the primary needs. They are not secondary needs. They are exotic needs. And so therefore, by the time you are saving money to do the third level, that is the self-actualization, you must have been able to take care of your security needs and your important needs. This is not a priority, and that is why you are seeing here we are talking of your dreams and aspiration. So basically, when you start your journey towards investments, when you start your journey towards saving, let us have 3 categories in mind, and let us have very clear goals. Why do I want to save? Why do I want to invest? I want to invest so that I can achieve 1, 2, 3. And as I stated from the beginning, your goal and my goal are totally different. Your needs and my needs are totally different. So plan your journey independently, without peer pressure, without saying that Annette is doing 1, 2, 3, so Alex should also do 1, 2, 3. Everybody in this life learns his own independent race. Run your race. Start your race now towards saving and ensuring that you have a secure future. And you can only do that by making the first step. And there is never a point where you'll have enough to save. You have to make sacrifices. You have to make adjustments. You will never have enough money that now you can be able to say, now I'll be saving this amount of money. No, 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 no. The point of beginning is now, where you will say that if I'm earning $100 per day, let me save 10, let me save 20 deliberately. Because that $20, you'd have used it elsewhere, but you make choices. You decide, I am not going to use this money for this purpose, let me use it for the future. And that is why I'm stating here, you don't have to have your security basket fully funded for you to begin the pursuit for an important or aspirational goal. Start by funding your security basket, but it is not a must. It must be full. You can adjust your security basket to allow you to have enough to save for a brighter tomorrow. List of goals, how to handle your goals, you need to list them down. What is not listed is not important. So start by taking a pen and a paper. What is important to you? After you list all the needs that you have, you're saving for your education, you're buying a new car, you want to start a new business, you want to start a holiday, or you go for a holiday, you want to start paying for your retirement pension, you want your insurance fund, you want an emergency fund, list them down. After you list them down, categorize them. As we have agreed, there are 3 important categories: security, important, aspiration. For example, if you are just about to join university, then saving for education is more important than buying a car. If you have already done your undergraduate and you're already in employment, then you may not need to necessarily save for your education. Maybe your master's degree, that's what you may need to save for, but as well, you may need to buy a new car. At the same time, if you have done, you are already working, you have already achieved your new car, you have bought your home, then you may need now to start a business. At that point, your list keeps on changing. That is why it is important. At whatever category in life you are in, you have to categorize your goals. And that is why, as I told you, that is why whatever is important, for example, right now for me, what is important is I need to plan for my retirement. I need my health insurance to be bigger and probably manage an emergency fund or even start a new business. So for me, then retirement and health insurance becomes a security, and it is no longer in the important category. It becomes a security, so that I plan with it. After you categorize your goal, then you need to move to the quantifying the cost of that goal. How much is the car that I want to buy? So after you quantify the costs, then you will know that if my car is worth $1,000, $2,000, and my salary is $200 per month, then how much money do I need to save for me to acquire this car? And can I talk to my bank for it to fast track this goal? I take a loan, buy this car, and continue paying with these $200 that I'm saving per month. That is how you prioritize your goal. So the first step is to list your goal, categorize it, then quantify. After you quantify, this will help you to know the exact amount of money you need to put in place so that you can achieve this goal. You will need to prioritize this goal depending on your age. As I said, my age, what could be important now? Your retirement, maybe starting a new business. If you're in the university, then your education is much more important. If you've just been employed, probably buying a new car is important. So priorities will change depending on the age that you are in. Moving very fast to the instruments that you can use for saving. We have three main classes. We have cash and what you call cash-like assets. Cash is what you have money in the hand and money at bank. Cash-like assets, you can put your money in a fixed deposit account. You can put it in a call deposit account. You can also put your money in a fixed income. Fixed income is, for example, Treasury Bonds, Treasury bills. You can also put your money by buying shares and equities. The beauty of these three categories of saving, once you need your money in an emergency, you can be able to access it within a short span of time. Other instruments and other classes that you can use for saving is real estate. You can put in commodities, gold, silver. You can put in private equity, managed futures, currency trading, hedge funds. These are categories that they can help you put your money and manage it. Cash, why do we need cash? Cash, we use it for emergency needs and for liquidity. This is to enable you make investments when opportunities arise. It is also good to have cash and cash-like assets because in an emergency, you can be able to access this money and can help you sort out the problem. The liquidity can be deployed when you have a lucrative opportunity that comes your way. These opportunities do not knock many times. They may probably knock once in a while. And when they knock, you need to nip them at the bud. And you can only nip them if you have money already at hand. I thought it's important that I probably touch on a bond for people to know what is a bond. A bond or a treasury bond is a promise to pay. It is a debt. A bond is a loan that is between the borrower and the lender. Most of the time we have government bonds and corporate bonds. Government bonds are bonds that the government has borrowed money from the public and has issued the bond and promising that at a certain period in time, it will pay back the principal and the interest. In Kenya, bonds, the interest, they are paid annually, semi-annually, every 6 months, the government will pay. We have bonds that are 2 years minimum to 30 years. The longest bond we have is 30 years bond. The borrower, that is the government or the corporate, agrees to pay that bond back in a particular period of time, and a particular interest rate. For example, the recent bonds that we issued in Kenya, we had a 25-year bond that we're issuing at 13.4%. That means that you give the government money for 25 years, and every year your money comes back with 13.4 interest, 13.4% per annum. Issuers of bonds are called the borrowers. The investor is the lender or the creditor. As I had mentioned, we have two types of bonds. We have the government bond, treasury bond, municipal bond, or corporate bond, and they are structured by floating rate or fixed rate. Fixed rate is just what I've mentioned. We had a 25-year bond that was issued at 13.4 per month. Floating rate is where the government will tell you this one is measured by treasury bills. They will say that, for example, the current treasury bill rate plus or minus 3 or 4%. Investors do not like the floating rate because it does not give them the fixed return that they are looking for. So even you, I would advise it is always best to fix your money when it is earning a particular interest rate. Briefly, let me look at the future of finance. Finance is facing, like every other sector in the world, it is ever changing. And there are three main components of finance that will shape it as we move forward. Number one is technology. Before COVID, we used to have physical meetings. Today we have a meeting courtesy of Zoom through technology. That is how fast the world is changing. So technology will play a significant role in supporting the future of finance. And it will play two main roles: automating traditional functions and enabling more sophisticated analysis and insights. Let me give you an example of technology and how it is shaping finance. And I'll give you an example of a farmer based in Laikipia. Laikipia is a county in Kenya that is about 200 kilometers north of Nairobi. That farmer farms wheat in an acreage of 5,000 acres. 5,000, that farmer, what he uses is satellite imaging, where satellite images will give him specific rainfall patterns that the rainfall is expected to be 10 millimeter from the 20th of October to the 20th of November, with brief rainfall from 10th of December to 20th of December. What does the farmer do? With that accurate information based on satellite imaging, that farmer ensures that he has planted 2 or 3 weeks earlier than the expected date of rainfall. That is something that was not there in several years ago, and farmers would rely on looking at the clouds, predicting weather patterns, and what would happen is poor harvesting. But with the current technology, that farmer is able to plant precisely on the precise dates, and they are able to benefit from technology. That is the same thing that is happening in finance. So technology is helping and is going to shape the future of finance. Data analytics. We have unprecedented amount of information that the world has, and this amount of information is finance is accepted finance, and will certainly drive planning and support business management. Right now, wherever you are, wherever in this world, you just need to Google whatever you need, and very fast information will come through. So moving forward, companies that are doing mergers and acquisitions, the information and the data that is required of them will be easily accessible, and therefore will help investors make very accurate and predictable decisions, and therefore help the face of finance. Business partnerships will continue being there. The world is becoming competitive every day, and so therefore the best will survive. And the only how best will survive, they will survive through mergers and acquisition or injection of capital. So briefly, that is the future of finance. I would want to share for more videos. We have a program with FIDA run by one of my directors called Rina Hicks, Moneywise. You can find it in Amazon, and you'll see videos. On Friday, I'm tackling another topic. You can be able to see videos and also grow in our journey. Thank you very much. Briefly, I'll take a few questions. Those are my contacts. If you want to invest in bonds, learn more about fixed income and what have you, feel free to share an email, and we'll appreciate. Dr. Taras, back to you.
Thank you so much. Yeah, thank you so much. All I want to say is that I wish somebody gave me an overview like this 20 years ago. So very useful, obviously, for the young people, you know, to be a little bit more financially literate. So
it's never too late. You can always start.
Never too late. Yeah. Well, by now I'm hoping that I'm a little wiser and I'm actually following much of your advice. Trying just like you described. So yeah. One issue that I am struggling with, and I'm not sure if there is a single correct answer to this question, is at which point it is wise to get into some risky investments. So let's say, for example, there is an investment opportunity that potentially can cost me either all of my money or, well, all of my liquidity, but provide a substantial return on investment. So if it goes well, but then I can lose all my liquidity if it goes badly. And so let's say if everything goes bad, it will not bankrupt me. I'll just lose something, but there is a potential to get some substantial returns on investment. And so obviously at some point it may not be wise. So if the risks are too high, especially if somebody is approaching the retirement age, I guess it's not wise to play with risk investments. But I'm curious if there is if there are any kind of general rules of thumb. So when and at which point it would be acceptable or maybe even advisable to take a little bit more risk. I don't know, what's your philosophy on that?
I think there is a general rule, there's a rule of the thumb in regard to that. When the risk is high, always invest what you can be able to lose.
Right.
So you do not go in, you do not test the waters with your 2 feet, you may drown. So you need to test the waters with 1 foot, check, then you can drop the other. But in this, so that is why it is important to, first of all, invest what you can be able to do. Secondly, we go back to the Maslows hierarchy of needs. There are things that you do not put into risk. Your home, you need to have an income or a security that can be able to cover your 6 months salary. So that in case the investment goes south, then you are able to meet your basic security needs for 6 months before now you find a better footing. So rule of the thumb, invest what you are ready to lose and take care of the security needs. Lastly, an old friend of mine advised me, and I usually advise people, especially even when they are even coming to buy shares and securities. You go to shares and securities as a third level of investment. You start your business. From the profits of your business, that's the money that you put into shares and bonds. Why? Because your business will give you a certain return. Shares may dip and you may lose your investment. But remember, you have your business, you have your salary that you can go back to. You do not start with shares. You put all your salary into the shares. Then when they go south, you have nothing to run to. So rule of the thumb, invest what you're ready to lose.
That's a very wise advice. That's a very wise advice. Yeah.
Thank you.
Yeah. Perfect sense. There is a very interesting question here from Petra, and again, so a passive income for young people. Do you sort of believe in passive income? Should young people start thinking about it? What's your philosophy here? Everybody seems to be talking about it, but I've seen very few people who actually have significant passive income where they can just relax and sort of, you know, live off the passive income. So it seems to be like a mirage, you know. It does happen to some people, but I'm yet to see someone, especially at a relatively young age, who does have an independently built, not inherited, but independently built sources of passive income. I'm curious, what's your philosophy on that?
Passive income, again, in this life, you run your own independent race. You may be able to get your passive income. Probably your parents were able to bequeath you some rental income, and so therefore you have some passive income. Or they had bought a bond that continuously gives you a certain return. But where you are starting from zero with no source of bequeathed wealth from the previous generations, then you may need to go out of your way and probably start doing some online jobs to ensure that you have some passive income that can be able to bridge the gap that you have between the amount of money you are getting from home and your needs. So basically, the only source that you can be able to get your passive income is if you go out of your way, get a job that maybe not be straining as much, but is able to give you a few shillings here and there that will ensure you run all your errands and you bridge the gap. Yeah.
I can add to that. I mean, obviously, again, it's a very interesting topic, passive income. Everybody wants to have something on the side that gives you some additional income every month without you having to do anything. I've experimented with two sources of passive income. And as I said, I'm a little, not really disillusioned, but there are some trade-offs. So I have some money in savings account and some money in bonds. The problem with that is that at least at this time in the United States, the return, the interest rates are very low. So the savings accounts in the United States at this time give us about 1.1% annual. If you put it in so-called term deposit, so where it's like a savings account with a specific term on it, where you cannot withdraw the money and for a specific time, you can get up to 2%. I think the highest I have is 2.4%. But it was invested a long time ago before the interest rates went down. So today, the highest I could get if I wanted to would be probably about 1.5% on the five-year investment. So, and likewise, similarly, I do have some rental property, although I'm not sure if I would call it passive income because it does require some attention and once in a while sort of requires you to be involved. So you can hire a professional company to hire properties, but in that case, again, the management company will eat up most of the profit. And so your return will be not really that high. Again, depending on the location, depending on the circumstances, it seems to me that at this time, you're lucky if you get 4 or 5% annual and possibly less. And so the challenge here is it's not that it's impossible to build passive income. The challenge is that could this money be used better elsewhere? And I don't know, again, maybe Mr. Wachira here has the answer, but for example, I have some, not a huge amount of money, but I have some money in the savings account getting, as I said, 1.something% on it. So in one sense, it is a passive income. And as long as it stays in the account, I'll be getting, certain cash every month. At the same time, I always think, well, can I do something more productive with it? Maybe take more risk and put it in stocks. Still passive income, but obviously more risky. So over the last 10 years or so in the United States, the returns have been 10 to 15%, kind of slowed down obviously lately, but ever since the recession of the 2009, the stock market has been growing relatively quickly. But then again, as Mr. Wachira said, you never know what's going to happen tomorrow. Maybe again in the United States, maybe the new election, the new president or the old president, changes the course. And we are back at where we were in 2008. Everything crashes, you lose 70% of your wealth. Maybe I should invest it in some other business, but again, the same thing. So potentially greater return on investment, but also potentially new hassle, new things you need to learn, new things you need to establish, takes time, takes effort. And then again, no guarantee that it will be giving you higher return. So I'm not sure what the philosophy here is, but Mr. Wachira, so let's say if you live in a country where the interest rates on, for example, bonds and other forms of secure investment are, let's say, 1 to 2%, as it is in the United States. Is it wise to keep money in those kinds of investments given the very low yields? Or is it better, especially while you're still young and have a steady income and have some time before you have to retire? So basically when you can still take a little bit higher risks, would it be advisable then to maybe play with stocks or maybe do something else? Or is it good to always have at least something in these very secure government guaranteed bonds, for example, or savings accounts?
Dr. Tavas, of the recent about 5 years, we have been having a lot of investments, offshore investors coming to the Kenyan market and buying treasury bonds. More so London, South Africa, Johannesburg, and a few investors from the US as well as Middle East. The reason is that in sub-Saharan Africa, you are finding that we have a relatively better yielding corporate bonds, government bonds, as well as slightly higher returns on equity shares. For example, you'll see that our 5-year bonds, you have a guaranteed return of 10.5% per annum. Our 10-year bonds, you have a guaranteed return of 11.8% per annum. 20-year bonds at 12.5% per annum, and 25-year bonds at 13.4% per annum. Those are relatively high interest rates.
Those are very high. Those are very high. How safe are they? I mean, what are the chances that something goes wrong and the government or whoever, the bond issuer is not able to pay up?
Well, at the moment, the government of Kenya is at Class A rating from IMF and World Bank in terms of defaulter. So we are sure that in the medium term, not unless something out of the world happens, out of the blues happens, we are sure that it will be able to meet its obligations. So
and those bonds are denominated in which currency? Is it local Kenyan currency or?
Yeah, Kenyan currency. The only bond that Kenya has that is denominated in a foreign currency, USD, it's a Kenyan Euro bond that is listed in the Irish Stock Exchange. That one is a dollar denominated.
And what are the interest rates on that one?
At 6%. 6% for a 10-year bond, 4.5% for the 5-year bond.
That's actually not bad at all compared to, yes, the local currency. I mean, obviously there is a risk of inflation as well. So I think, yeah, but yeah, that's a very interesting proposition. I mean, that's, 2-3 times as, even if the ones that you say denominated in the US dollars, that's like 3-4 times what the US market pays now. So still very interesting.
Correct. So in terms of opportunities, there are several opportunities. The world now is a global world, and you're able to reach out to everyone everywhere in a very short span of time. And one of the things that probably you may need to explore is probably investing offshore.
Yes.
And you can start small and grow step by step as you see the kind of returns that you are getting. Yeah.
Good advice. Well, I know we have another webinar actually should be starting a minute ago for the coaches. So I think, Annette, we need to stop here. And sorry, so we took so much time. I know we normally aim for about 45 minutes, and here it's been a little bit longer than an hour now already. Thank you so much, Mr. Wachira. So very, very informative, and thank you for willing to share your contacts. I hope you will not be overloaded with the emails from students.
No problem. I'll try as much as possible to answer them.
Thank you so much for your words of wisdom and experience.
Thank you, and have a good day.
Thank you, Annette, for organizing this meeting. So very informative. We should do it more frequently.
Thank you, Dr. Vas.
All right, thank you. So I guess we need to stop here so that the other webinar can start. We cannot do two at the same time. Thank